The kingdom of happy creatures and singing princess hasn't been that charming for the investors lately. In fact, Disney is currently at its lowest point since 9 years and it is currently down of about 30% year to date. Plus, with the recent news that we've seen, the situation may even become worse in the next couple of weeks. Hey, how's it going guys? It is Louis Olivier and today I'll share with you a full stock analysis on the company Walt Disney with the ticker DIS. As always, I'll start by talking about what is the business model of this company, so how are they able to generate their income, and after I'll talk about the most important recent news that we've seen about this company, to talk after about the most recent earnings report, and I'll finish by a quick fundamental analysis to see if this company is currently under or overvalued right now. This American gem created in 1923 was initially created as a cartoon by its founder, the infamous Walt Disney, about a little girl called Alice in Wonderland. And so he decided that he could use it as his pilot film to sell a series of these Alice comedies to a distributor in 1923, and the rest was history. You've seen that through times there was multiple new creatures that have been added to the Walt Disney Company, from the fantastic creatures such as Goofy, Pluto, or the infamous Mickey Mouse. After the massive success of these movies and miniseries, the company grew and built multiple attraction parks all around the world, with the first opening in 1955 in Anaheim. Through the ages, we've seen that this company has grew all around the world with multiple attraction parks even outside of the US, and a bunch of very popular movies and miniseries. Plus, more recently, we've seen that with the coming of the internet and of multiple online video platforms, we've seen that Disney has made many acquisitions on that side, where they've bought ESPN in 1996 and they also acquired Hulu in 2019. Plus, on their side, they've also created their own platform which is called Disney Plus. All of this makes that right now, Disney earnings can be divided in two main branches. First, you have the Disney Media and Entertainment distribution, which includes every broadcast and streaming services as I just mentioned. In the third quarter of 2023, this branch was worth about 62% of the total earnings of this business. And the last branch is called the Disney Parks, Entertainment and Products, which include obviously all their numerous parks around the world in France, Japan and in the US, but also the sales of their numerous products such as toys, clothes, books and video games. But in that case, why have they lost so much value lately despite having a quite well diversified business model? Well, one of the biggest problems that exists for Disney at the moment is coming from the big competition that exists in the entertainment field. Indeed, with all the Netflix, Amazon Prime and YouTube of this world, the online video field has become quite saturated where every big companies want their own part of the pie, and it makes that even big companies such as Disney that have been on that field for many ages now have quite a lot of difficulties to grow their audience. In fact, for both ESPN Plus and Disney Domestic Plus in the third quarter of 2023, we've seen a slight decrease of the number of users, but despite that, they've still been able to grow their audience in terms of Hulu and Disney Plus International. Unfortunately, the reduction of the number of users for both Disney Plus Domestic and for ESPN Plus is notably linked to the high cost of these services. In fact, when we take the monthly subscription to Disney Channel Plus, you can see that it costs about $12 per month, which might seem not that much, but when you compare it with Netflix that costs only about $7 per month and Amazon Prime that only costs about $5 per month, you can see that there's still a massive gap. Plus, obviously, with the cost of living that has been massively increasing over the last couple of years, and with the interest rates that is through the roof at the moment, well, it means that people still have less money in their pocket and they need to cut somewhere in their budget. But this isn't the only problem of this company. In fact, at the moment, the firm is currently facing two important Hollywood strikes that have frozen television and film production. They are also facing recently an important battle over some fees with a large cable operator called Charter Communications, where nearly 15 million cable viewers lost access to ESPN, ABC, and other Disney-owned channels over Labor Day weekend because of the failure to renew a distribution deal. well. Add to this, a few weeks ago, they've also faced some legal problems with the Florida governor Ron DeSantis, and at the same time, they've received a bunch of critics and backlash over their last couple of movies that is considered as too much woke for the kids, and so their problem with Charter couldn't come at a worse timing, notably knowing that the problems persist despite being at less than 1 week before the beginning of the Monday Night Football. Add to this, the experts look to agree that there are no possible ways that this situation will resolve positively for Disney. But despite that, in their latest earnings report, we've seen that they've been able to continue to grow their total revenue, but the same cannot be said about their total net income. But now let's see what the valuation metrics are telling us about this company. The first thing that we can notice is that despite some massive downtrend lately, we can see that this business is still worth about $150 billion at the moment. However, with a quite high price to earnings ratio of about 66, showing that with this indicator, this company would currently be overvalued. But when we take a look at both the price that you'll pay for the sales and for the book value, you can understand that both of these indicators are showing that this stock would currently be undervalued on that side. Over the last 12 months, we can see that Walt Disney hasn't been able to achieve some incredible profit, operating margin, and return on equity. But despite that, over the same period, they've been able to generate some revenue of close to $88 billion, with a slight increase of about 4% in their latest quarterly revenue growth year over year. However, a pretty negative point about this company is that they currently have about 5 times more debt compared to their current cash position, showing that they are massively depending on the interest rate fluctuation. In terms of the volatility of this stock represented by the beta on a 5 years period, you can see that this company is slightly more volatile than the market with a beta of over 1, where over the last 52 weeks we can see that it has lost about 30% compared to a gain of about 8.44% for the market. But the great news about this company is that over the last 4 years, they have been able to continue to grow their total revenue year over year, and where their earnings before interest and taxes have been progressing on the right direction over the last 3 years, despite a negative 2020 due to the pandemic that closed many of their entertaining parks. As you've been able to see in this video, Disney, that was considered as a true American gem over the last couple of decades, that was recognized worldwide, is probably living its worst crisis of its existence. Scandals after scandals, they have slowly started to lose the interest and the patience of their shareholders that have been loyal to them over the last couple of decades, and obviously this has been massively reflected in their valuation progression over the last couple of years. I personally believe that this company might be quite interesting for people that have a very long-term horizon and that are willing to wait and see what will be the effect of the new CEO Bob Iger. But at the moment, in my personal point of view, this company is currently a little bit too much political for me. Some people might even say go woke, go broke, but personally I think that this company still has some potential upside, such as Meta, as we've seen over the last year. But until I see any kind of change anytime soon, I won't be trying to catch this falling knife, or I'm gonna cut myself. And I think that with the competition that we have in that field nowadays, the situation isn't the same for them as it was, for example, 10, 20 or 30 years from now. Add with all the multiple problems that they've faced recently, I think that it is a little bit too much for me to be able to say that I want to invest in it. However, on your side, if you're looking to find another great stock that have a lot of potential upside for the next couple of years, well, check out the video that's gonna be right over here, and I will see you soon. Peace!